This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 3, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is holding a narrow line at $744.78, but look closer at the Nasdaq. The QQQ is down nearly 1.75%, dragged down by a tech sector that has shed nearly 3% today. We are witnessing a clean, violent rotation out of growth and into defensive value, and the silence in the VIX makes it look deceptively safe. Before we dissect the flows, let's look at the calendar. There are no major macroeconomic releases scheduled for today, July 3, 2026. However, we are tracking earnings and corporate actions from several mid-cap names, including AUK, APM, BDRX, and BHM, though none represent the systemic weight of the megacaps driving today's narrative. On the horizon, July 8th brings earnings per share estimates for AZZ and BSET, but our immediate focus is strictly on the intraday rotation occurring right now. Apex, what does the absence of external noise suggest about this move?
It suggests this is endogenous. Without a macro event to blame, this is pure portfolio rebalancing. The market is choosing sides internally between duration and value, and the lack of scheduled data means the price discovery is happening entirely on the order book right now.
Here is the snapshot as of 9:19 Eastern Time. SPY is essentially flat at $744.78, but QQQ is red at $712.60. The divergence is stark. The technology sector, is off 27 basis points, while the healthcare sector, is up 2.63%. Financials, the financial sector, are green 1.53%. Small caps IWM are down 0.5%. The VIX sits at 16.59, practically unchanged. Grid, walk us through the structural breaks.
Structurally, the Nasdaq is fracturing. QQQ is trading at $712.60, which puts it dangerously close to its 10-day low of $702.81. We are only roughly $10 away from that floor. Meanwhile, SPY is consolidating in a very tight band around $740, sandwiched between yesterday's low and the July 1st high. But don't let SPY comfort you, the underlying engine. The technology sector is collapsing. The technical picture shows QQQ rejecting resistance at the July 2nd open of $725.58 with zero follow-through. This isn't a healthy pullback, it's a breakdown of the momentum structure.
And the small caps?
IWM is at $297.58. It broke below its consolidation zone and is facing hard resistance at the July 2nd open of $300.54. The defensive rotation is failing to catch fire in the Russell 2000 space, meaning this is a large-cap tech unwind, not a broad-based recession play yet.
Let's talk about the movers driving this flow. First, ACLs has gapped down 18.7% on 9.2 times normal volume, driven by sales from James Investment Research Inc. Second, Apple is bucking the trend, up 4.8% on 7.3 times volume. And third, CrowdStrike CRWD has collapsed 74.9% on 8.7 million shares. CIPHER, break down what these three moves tell us about institutional positioning.
This is a textbook liquidity purge. ACLs is seeing institutional exit. James Investment Research is unwinding positions rapidly. But look at the counterflow. Apple is seeing massive accumulation. Smart money is using the sector rot to pick up quality balance sheets while shedding speculative beta. CRWD collapse is a fundamental breakdown, likely guidance-related, removing another piece of the mid-cap software puzzle. The narrative here is survival of the fittest within the tech complex.
So we have selective accumulation in legacy tech, while speculative tech gets bled dry. Pulse, does this volume profile signal fear or just adjustment? It signals controlled panic, but mostly boredom. The VIX is stuck at 16.59, inside its 5-day range of 15.97 to 20.72. Retail isn't fleeing, they're waiting. The sheer volume disparity, 9-fold surge in ACLs selling versus 3-fold accumulation in Apple, shows institutions are hedging the downside rather than chasing the upside. The sentiment is neutral to cautious because the VIX refuses to spike. If retail thinks this is just a dip, they are walking into a trap.
SPECTER, is that calm justified?
It's dangerous. A VIX at 16.59 amidst a 27 basis point hit to the technology sector implies the options market is mispricing the correlation risk. We usually see volatility expand when sector leadership collapses this sharply. The fact that it hasn't means the leverage is still hidden. If the technology sector continues to decouple from the financial sector, we aren't looking at a correction. We are looking at a regime shift where the soft landing narrative dies quietly.
Let's dive deep into the heart of the issue, the technology sector's collapse. The technology sector is down 2.71%, dragging QQQ with it. Grid, what is the chart telling us about the sustainability of this drop?
It's telling us there is no support left until $702.81. QQQ is trading in the lower quartile of its 10-day range. The rejection at $725.58 was decisive. Volume on the decline is expanding while volume on the bounces is vanishing. This is a classic distribution pattern. Unless the technology sector can reclaim its moving average, which it isn't doing right now, the path of least resistance is down to test that June 26 low.
CIPHER, is this a sector-wide valuation reset, or is it specific names bleeding?
It's both, but the beta is leading the charge. You mentioned CRWD crashing 75%. That's a specific fundamental failure, yes. But look at the breadth. The technology sector is down 2% for the week. This isn't just one bad apple. It's the entire valuation model for long-duration tech assets getting repriced. The yield curve is flat at 35 basis points, with CPI at 4.17%. The market is punishing companies without cash flow. ACLs and CRWD are casualties, but even the giants are suffering from multiple compression.
Pulse, does the sentiment data agree that this is a broad reassessment of tech valuations? Agree. I think they're underestimating it. The put/call ratios in the big tech names are skewing, but broadly, the crowd thinks the VIX at 16.59 means all good. They are ignoring the internal divergence. When the technology sector falls and the healthcare sector rises, you lose the correlation hedge. Traders who use SPY as a proxy for safety are realizing SPY is being propped up by energy and healthcare, not tech. That realization creates delayed selling pressure.
SPECTER, you warned about the hidden leverage. Where is that leverage hiding in the tech complex right now?
It's in the gamma exposure. Because the VIX is suppressed, dealers haven't been forced to hedge aggressively yet. But look at the ACL's volume, 9 times normal. That's institutional deleveraging. When institutions sell that hard without a corresponding spike in the VIX, it means they expect the pain to be contained but continuous. The risk isn't a flash crash. It's a slow bleed that traps the longs who refuse to accept that the growth at any cost era is paused.
I want to tie grid observation of the $702 support level with CIPHER note on valuation compression. Grid says the chart demands a test of that floor, and CIPHER explains that the macro environment, flat curves, sticky CPI, removes the justification for premium multiples. Together, they confirm that the QQQ breakdown isn't technical noise, it's a fundamental validation of the chart's bearish bias.
While tech bleeds, capital is flooding into defensives. The healthcare sector is up 2.63%, and the financial sector is up 1.53%. Grid, how are these charts behaving compared to the Nasdaq?
They are showing relative strength but not breakout strength. The healthcare sector is pushing higher, but it's doing so on lower volume than the tech sell-off. This suggests it's a flight to safety, not a new bull run. The financial sector is testing resistance, but remember the yield curve is flat. That cap on bank margins limits how far the financial sector can run. These charts are stabilizing the SPY index, preventing it from matching QQQ's red ink.
CIPHER, why are flows moving here?
Because the numerator is hitting the denominator. In tech, the future cash flows are being discounted more harshly due to the 14 basis point 10-year, 2-year spread caution. In healthcare and financials, you get near-term cash flows or regulatory moats. The healthcare sector is rising because it's boring, and in a 27 basis point tech drawdown, boring pays a premium. We are seeing a de-risking trade, not a re-risking trade.
Pulse, is the sentiment shifting safely into these sectors, or is it just fleeing the other?
It's fleeing. Look at the VIX again, 16.59. If investors were truly confident in healthcare as a growth engine, the VIX wouldn't be this lethargic. It would be creeping up on the back of increased participation. Instead, this looks like capital preservation. People are parking money in the healthcare sector because they don't know where else to go in tech. It's a defensive moat, not an offensive wedge.
SPECTER, is there a risk that this rotation fails?
Absolutely. If the healthcare sector starts to struggle, it confirms that there is nowhere to hide. Currently, the divergence between the technology sector down 3% and the healthcare sector up 2.5% is widening. That spread is unsustainable if the broader market weakens. If the S&P 500 breaks below its own support bands, the safe havens become just another asset class to dump. Watch for the healthcare sector to fail. That's your early warning system for broad systemic stress.
Connecting the dots, Grid notes the stabilization in defensive charts, while CIPHER identifies the macro-driven capital migration. But Pulse reminds us this is fear-based parking, and SPECTER warns that if the SPY support cracks, these defenses offer no shield. The synthesis here is that the market is searching for equilibrium, and currently it's finding it only by abandoning growth entirely.
Finally, the anchor, SPY at $744.78. It is barely moved, despite the chaos in the components. Grid, is this stability genuine or artificial?
Artificial, SPY is resting at $744, just above the July 2nd low of $740. It is consolidating because the weight of the index is diversified. You have diamonds up 1%, the energy sector up 0.78%. The heavyweights outside of tech are propping up the average. Technically, SPY is in no man's land, too high to be a buy, too low to be a sell. It is waiting for QQQ to decide its fate.
CIPHER, does the fundamentals side support a hold at $740?
Not really. The earnings revisions for the S&P 500 are turning negative primarily due to the tech segment. The other sectors are stable, not growing. So SPY is essentially a bond proxy right now, not a growth vehicle. Holding $740 requires faith that the technology sector won't fall further. Given the ACLs and CRWD headlines, that faith is thinning.
Pulse, is the crowd comfortable with this flat SPY print?
They are confused. Flat means indecision, but paired with a down NASDAQ, it creates cognitive dissonance. Traders are watching the VIX at 16.59 and thinking no danger, while the tape screams risk off. That confusion keeps the bid alive, but it's fragile. One break below $740 triggers algorithmic stops that aren't present at $750.
SPECTER, what goes wrong with this consolidation?
Time decay. The longer SPY chops in this narrow band while the technology sector crashes, the more frustrated the buyers become. Eventually, the boring sectors like utilities and staples also get sold if the deflationary fears hit. Right now, the utilities sector is up 2.21%, but that's a last stand. If SPY holds for another day without resolution, the explosion happens on the downside, not the upside, because the energy required to push it higher isn't there.
So Grid gives us the mechanical floor at $740, CIPHER confirms the fundamental erosion behind it, and SPECTER argues that stagnation breeds instability. The consensus is that SPY is a passive observer until QQQ hits $702.81. Let's lock in the framework for the session. We have Grid identifying the critical QQQ support at $702.81 as the primary technical fault line. We have CIPHER explaining that the macro environment, specifically the flat yield curve and sticky CPI, provides no justification for the current tech multiples, validating the rotation into the healthcare sector and the financial sector. And we have SPECTER warning that the suppressed VIX at 16.59 is masking a liquidity trap, particularly in names like ACLs experiencing 9 times volume. The directive is clear. Monitor the QQQ $9 buffer to support, respect the defensive rotation, and recognize that low volatility is currently a liability, not a safety net.
To summarize, the S&P 500 is holding at $744.78, but the underlying structure is weakening. The NASDAQ faces a critical test at $702.81, driven by a 27% drop in the technology sector. Capital is rotating into healthcare and financials, but sentiment remains dangerously complacent with the VIX anchored at 16.59. Tomorrow, watch for QQQ to either defend that June 26 low or accelerate the breakdown. Until then, the data shows a market in transition, not equilibrium. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.